Hey everyone, in today's video we're going to take a look at how my $263,000 Wealthsimple stock portfolio did over the last week. We're going to look at some of the buys and the sells that I've made in this account over the last week, and then just look at some of my positions that reported earnings. I'll give some thoughts on that, and then just other interesting things that happen in the market. So if you like this kind of content, be sure to give this video a big thumbs up. Helps a ton with the algorithm, but we'll just jump right into it. You can see here off the bat, my Canadian portfolio was down about $300 on the week. US side was up about $300. It was pretty much a wash on the week. With that being said, still up really nicely and holding gains from the last 3 months, over 10,000 US on that side, and then about 15,000 on the Canadian side up. So 10 and 15% up in the last 3 months, which is awesome. Looking at the broader market here, S&P 500 was up slightly on the week. Over the last 3 months, you can kind of see it's also been ramping up. Let's give it to October, give or take. So yeah, up a good 15%, in line with kind of some of my portfolio gains. And then also looking at the NASDAQ 100 here in the last week, it's bounced around a bit, ended the week flat. Last 6 months, it's also boomed from October 30th to now up 20% as well. And I have some of those names in my US portfolio, which is really helping that one be up 16%, as we just saw a few moments ago. So overall, portfolio has been holding the gains that we've been getting as of late, and I'll take that. I'll take 11 and 15% over the last 3 months, even if it means the last week didn't really deliver anything. I've been trying to be a bit more conservative in what I've been buying and selling in my account, just because the market's run up and valuations have run up a bit. So I'll start with some stocks that I actually ended up selling, and it's mostly been ETFs in the last week. One ETF that I had a decent sized position of that I let go was XIC. This was a Canadian S&P TSX index here. Looking at it over the last year, it really ramped up on me about a bit there. As you can see, went from about $30 up 10% in the last quarter. And I really only bought this one about midway through the year. So I sold out for about a 6 to 7% profit on it. It wasn't to take the profit, but at the end of the year, I really just took a step back entering 2024 and told myself that I want to make sure, even though I want to be more diversified in different holdings and coverage of more of the market, I wanted to have more of an objective of how I did that. And I came to the conclusion that owning a Canadian market ETF, given how much of my investments are already in Canadian equities, didn't really help diversify in the most effective way. So I'll share in a couple of minutes where I ended up putting this money to try to better geographically diversify. But that was one of the reasons I got out of this one here. I just didn't think it was really doing anything different for me other than all the other Canadian stocks I own, like CN Rail, the banks, the REITs. It just wasn't additive to the strategy. So I decided to dump XIC this week. Another one that I dumped in my unregistered accounts here was HDIF. And if it was one lesson that I've learned, or one thing that people have educated me a lot about, is just the benefits of better leveraging my registered account for these super high dividend or super high distribution stocks that I just get extremely unfavorable tax treatment on at the end of the year. So this is one I owned. I owned 500 shares for about $4,000 of. The stock's actually been, I think I average in a bit. So I've actually been flat on this one since buying it about 2 years ago, which has actually been pretty good because it has a super high covered call ETF on it of over 10% yield. So this has pretty much been my return since holding the stock overall. But that 10.4% yield, I'm probably getting extremely heavily taxed on it. So I moved it over into my RSP by selling it out of this account, freeing up some cash for more productive dividend treatment stocks, and got this one out of this account. And covered calls in general are not really an area of my portfolio. It's pretty small to start with, but not an area I'm looking to grow. Just like getting that monthly income to reinvest in other areas I'm more focused on growing. Eventually, I may start winding these ones down as I kind of hit my monthly and annual passive income targets without needing some of this extra income. I may start mixing these into my equities a bit more just because I don't like the 0.75% management fee on them. I think over the long term, especially if you're unable to hold them all in registered accounts, it's a lot of taxes and inefficiencies by holding them as well. So they definitely serve a purpose for the right kind of investor, the right type of objective. But for me, first of all, I didn't think this was the right place for this one specifically with that 10+% yield on it. And two, as my portfolio gets more developed and I have more and more income coming in from organic, for less of a better term, dividend sources, I may have less of a need for these types of investments. And then the third ETF, and this was a very similar story as XIC in terms of why I got rid of it. VXUS, this was a global stock equity ETF essentially. It held stocks from the entire world except for the US, which I thought was fine just because I have so much US exposure as well through some of the Dividend Kings and other big cap companies I own. But ultimately, it's a very similar story. The last handful of months, it actually ran up 7-8% for me, which was great to get out of at a decent profit, even though I've only held it for 3-4 months. But when I looked deeper into this one again, I saw I had 40% exposure to Europe, and I already have a huge position across multiple accounts in ZDI, which is primarily a European dividend ETF. So I didn't think I really needed to double dip on that. And lots of the areas of the market that I'm really underdeveloped on, like Asia, Pacific region, etc., it didn't really have a huge chunk of the ETF in that area. So I just didn't think it was working that hard for me to diversify, which was ultimately the primary objective of holding this one in the first place. So I decided to sell this ETF. Obviously, between those three sales, I raised a lot of cash in this account. All in all, I think I had about $6,000-7,000 of this ETF. I had just over 4,000 of HDIF. And then on XIC, I had a handful of thousand as well. So almost like $15,000 that I had available. And I'm going to share some of the stocks that I bought with that money. So the first thing I did was I pivoted my geographical exposure through ETFs into a couple different ones. The first one was VPL. VPL is a Pacific region equity ETF. It's like 60-something% Japan, with the remainder being Singapore, Australia, and I think a bit of Hong Kong as well. So that's kind of the area of the world that I really have very limited exposure to. So I thought that was more focused of an area to have an international equity ETF in. And it also pays a decent dividend, getting a starting yield here of just over 3%. The second ETF is more an emerging markets ETF. So this one here has 20% exposure to India, 30% China, 15% Taiwan, 7-8% Brazil, and then a couple percent in all these other emerging markets. I think it was like 1% in Egypt, a couple percent in Dubai, 3% in Mexico, stuff like that. So lots of emerging markets. In the last year, it's actually been down 6%. So with the rest of the market roaring, this one's actually trended down in these emerging markets. Thought it may be long-term a decent time to start a position, get a bit of a higher dividend yield here, 3.6%. And when I kind of share these stocks on my watch list or talk about international stocks or ETFs, I get a lot of comments on how long-term these have outperformed the U.S. market, the S&P, and how I should just focus on, the core positions. And I just like to say that I understand that, and I do think that realistically over the next 10, 20 years, the best approach would just be throw everything in Dividend King stocks, throw everything in tech stocks, throw everything in S&P 500. But my main objective of my portfolio isn't necessarily to maximize overall returns at all costs. I'm trying to manage risk. I'm trying to diversify heavily, be able to sleep at night really well with the portfolio, knowing that I have equities and exposure to all areas of the world, even if that means that over a 10 or 20 year period, I may only get a 6 or a 7% annual return instead of getting a 9 or a 10%. I'd rather give up the 2% knowing that I'm more diversified and I'm okay paying the price for that. So I get that those comments, I understand them, but that's just my perspective. A ton of my net worth is in my stock portfolio. Overall, I'm between equities and bonds. I'm entirely equities for the most part. So that's just how I layer in some conservatism, and just how I just feel more comfortable with my portfolio. Everyone's different. Some people may want to maximize returns. If I was trying to truly maximize returns and I didn't get joy out of managing my own portfolio, I'd probably just dump it all in an S&P 500, three or four of my favorite growth stocks, and call it a decade and just keep reinvesting. But I like to do it this way instead, even if it may not end up with the best overall outcome. So that's just some comments on that. In terms of other stocks that I bought this week as well, going down, one of the things I always do when I liquidate a big part of my portfolio is I just put it in these cash ETFs. So I think I bought about 75 shares here, or at a point it was 100, but I started sourcing a bit from it. And just these high interest cash ETFs to make sure I'm making some type of income via capital appreciation or the month end dividend on my cash when we're talking about such significant amounts. So in this account, have about 14,000 on PSA, have a bit more in another one of these cash accounts as well. Pays me about a 5% annual dividend yield paid out monthly. So still have a good chunk of some of the money that I sold in those ETFs that I just filtered to right away. But some of the actual stocks that I added to, Fortis was one of them. Fortis is currently paying a 4.2% dividend yield, pays a true dividend, so the taxing is not too bad on it. They have a dividend growth history of a long period as well, been increasing about 6% a year, which is nice. And this is one even in the last couple months as the market's really roared. Fortis hasn't really done that well. You can see here in the last 3 months down 4%. The overall market's up 10 to 15%. And I would think with Fortis and their interest rate sensitivity and the outlook for interest rates to go down, I would have thought they'd perform a bit better. So just trying to shore up this position a bit. I do own it in a couple different accounts, but it's not a huge position. Not trying to make it a huge position, but I think I have some more room to add a bit more. Even after I was building 10, 20 more shares over the last week, I think I may add another 10, 20 if it stays at this level in the low 50s or trends lower with this starting yield of over 4.2% here. Going through a couple other stocks that I added to as well. Pretty boring ones here. Added a couple shares of TD Bank. Just really like this business. It's one of my largest positions across all my accounts. They're expected to do about $8 to just over $8 of EPS this year, so trading at 10 times earnings. They've been able to compound earnings over the long term, high single digits, low double digits, have been increasing the dividend for decades and decades for the most part. And I really think they're a pretty high quality, low volatility bank with high exposure to commercial banking in great markets, both in Canada and then the northeast side of the US down to the southeast side. Really good developed markets and growing areas geographically, especially in the US. So really like this holding. Don't mind that it's on a dip here. Going to keep nibbling onto it as well. ZDI, I mentioned this one was my European dividend ETF here. Actually have been averaging up on this one over the last few weeks. So even with last week when I sold Jameson Wellness, put some of it into this international ETF here. You can see here up 8% on the year. Also got a monthly dividend on this one too, yielding 4.2%. Lots of the big holdings in this one here. Big European companies like LVMH. In addition to LVMH, think Nestle, Unilever, those kinds of businesses that are blue chip dividend paying stocks in the European stock market there. So don't hold many of those directly. Diageo is another one in this one, but I get that dividend, blue chip dividend exposure from Europe through this ETF. It does have a decent management fee on it, about 40 basis points, which I don't love. But you know, the 4.3% dividend yield makes up for it. And this is one that shows you can still keep averaging up on an ETF or on a stock and do well. So I bought majority of my position when there was, tensions going on in Europe with Ukraine and Russia. Stock was $17, $16 as people were concerned about a deep recession, energy sufficiency, stuff like that. And I've just been averaging up ever since. I was buying in the 20s, buying in the 21s, and now I was buying over $22. My average price still is up 16%, and every month that I keep buying, I keep getting a bigger and bigger dividend payout at the end of the month. So obviously, dollar cost averaging, people usually talk about it going down. But if you have a position that you want to keep a good size in your portfolio, or you want to build your exposure to it, sometimes it's not the worst thing to average up. If you were just to average down on stocks, you would miss out on huge opportunities on some of the best stocks that have gone up 100, 1,000%. You would have stopped buying in after your first couple shares. So just keep that in mind as well as you guys are, thinking about how to handle your portfolios here. I'm just going through, trying to remember other stocks that I've bought in the last week in this account. One more here that I added a bit in this account, but more in some of my registered accounts, was Dream Industrial REIT. This has been a pretty new position, just a month or two old in my account. So I just wanted to shore it up, get it to be a much more significant part of my portfolio. I think across my accounts now I have about 700 shares, so it's a pretty decent size now, about $10,000, making about 5.2, 5.3% dividend yield on it, which is great. Pretty small in this account here because I've once again have been trying to look into the best way and best accounts to hold these stocks in. And with REITs, it really does seem like they're best in a TFSA or an RSP, which is, if you're not Canadian, are tax sheltered accounts here in Canada. So one stock that I wanted to talk about that just reported their earnings that I hold here is Visa, one of my all-time favorite stocks. I hold it in a couple different accounts, up about 25% in this account. And it has just been really hard to catch over the last couple of years. I have been averaging up on it, but especially over the last few months, it's gone from down here in October in the 220s to 270. And they pretty much didn't have an earnings report over that time. But with that being said, looking at their earnings report from their last quarter here, they grew, I lost it, but I can just talk to it. They grew their revenues about 9-10%, earnings low double digits, continued to buy back shares, and that actually disappointed investors. You can see the stock here went down 2%. It was down 3-4% at one point after hours, as investors have just gotten really used to that high double-digit CAGR, 17, 18, 19% growth. And it seems like it's been some deceleration in that growth rate. So the stock traded down a bit, but I still look at it at $10 current year earnings, trading at about 26, 27 times, and then $11 next year, so trading about 24 times 2025 earnings. In the long run, if they continue to be able to compound at a minimum of 10% a year on earnings per share as they continue to buy back tons of shares and organically grow top line, get synergies to grow bottom line faster than that, I still think that by 2027, 2028, you're currently buying the stock at probably 20 or under 20 times earnings today of what those earnings will be just 3-4 years down the road. So for a company with a long history ahead of them, a lot of white space to drive card transactions away from cash, I think that this is still a good long-term opportunity, but lots has gotten priced in over the last few months. So it's not one that I've been aggressively adding to, but sometimes I'll splurge and add one share here or one share there, which you can kind of see here. I think at one point I was up 30, or I would have been up 30, 35%, but I've been averaging up similar to ZDI. Not really scared of averaging up. I don't really care or get lots of value out of showing very high percent returns. I'd rather maximize my absolute dollar return across my portfolios. Another stock I own that reported earnings this week was AT&T, and I actually thought AT&T did pretty well. They came in with a huge cash flow number that we'll get to in a second, The stock's up 3% on the month. They actually went down directly after earnings, but I think that was because I think this is it right here. Um, it went up after Verizon reported, since Verizon reported good numbers. I thought AT&T also reported good numbers, but I think people thought it would be even better. Stock went down, and now it's kind of rebounded back up to where it was after Verizon's report. Looking at their earnings, and one of the main things that I look for is their free cash flow. At the end of the day, this is like a funds from operations stock, lots of moving parts. All I care about is how much free cash flow they're spitting out. And there was lots of concern they were not going to hit their $15 to $16 billion free cash flow estimate just because the first half of the year came in extraordinarily light on free cash flow as they had to reinvest. But they did $6.4 billion of free cash flow just in the fourth quarter. Not only did they hit the high end of 16 billion, but they exceeded it almost 17 billion, 16.8 billion. And then next year they're out looking to do 17 to 18 billion in free cash flow. We're talking about a stock here that has a market value of $122 billion. So if they do $18 billion of free cash flow, that's like a six and change, 6.5 times free cash flow multiple for next year. And even this year, so like a 7 times free cash flow multiple. So I know they have debt. They've been, trying to pay it off slowly but surely. They cut the dividend a year and a half ago or so to make sure they're better positioned to manage that debt to EBITDA position. But I just think that at 6, 7 times earnings for a company that does have a lot of recurring revenues, especially on their wireless side and on their phone plans, I get that the cable and the direct TV position and stuff like that is in secular decline. But I think they have enough business that, or enough percentage of their business that actually isn't declining, is actually slightly growing, that this stock should not be trading at a 6 times or a 7 times multiple. So I just think it's fundamentally undervalued of their current free cash flow, especially if they end up growing it from 16.8 to 18. That's like a 4, 5, 6% growth in free cash flow when trading at 6 or 7 times, which is a multiple you'd give a stock on free cash flow if it's declining. Free cash flow is not growing it. So I think a multiple expansion can very well happen on AT&T. In the meantime, happy to collect my 6.5% dividend on this one here. The other one I want to talk about here, couple stocks here. One was Netflix. Netflix absolutely crushed their earnings, up 17% in the last week. And they weren't in a slump or anything like that. Netflix is up over 40% in the last 3 months. In the last week alone on the earnings, they went up 17%, now up to $570 a share. They're getting pretty close to those super high stock prices they were at during the pandemic when Squid Games was going nuts. You see it here, 675. So they're still about 15-20% away from that. But Netflix added over 13 million subscribers in one quarter. And this was on the back of adding over 8 million subscribers a quarter prior. So in 6 months, they added 21 million incremental net subscribers to their business. And everyone was thinking 12 months ago, this is a developed space. They're going to get really low growth on this now. It's too high churn. So this was an absolutely huge number. I was shocked to see it. And, a couple things stemming from this came to my mind immediately. The first one was I do own Disney in another account. Have owned it for a number of years. It's one of my worst positions. I am down overall on it. And I was just thinking, as millions and millions on a quarterly basis, over 20 million people in half a year spend more and more time with their attention on Netflix and in streaming, and it increasingly looks like Netflix rather, is just running away with streaming leadership with no real second place. I start getting concerned for my Disney position and my Disney stock. Linear TV is just in secular decline. They are pivoting into streaming, but clearly not quick enough, especially when we're looking at the kind of numbers Netflix puts up. So it'll be really interesting to see Disney's numbers. I'm hoping the shares, stay higher, go higher, to potentially give me optionality to just move on from this one and take the loss. Just because as I think of Walt Disney, a couple different pillars of their business. Obviously, linear TV is in decline, and that's been a cash cow for them. So they're going to have to offset that. one of the things that have been working for them is their parks business. But unfortunately, I just don't see how their parks business is overly scalable. You can only increase price so much. You can only have so many people in all the parks on a daily basis. So that concerns me where it's a super profitable business. I think it'll do well in the long term. I just don't know how they break through and have like complete overhaul of the business to make that the primary profit driver that offsets the linear TV losses that they'll be seeing on a year over year basis. I just don't see a way, in simple terms, to really step change growth much farther than they've already been seeing on the park side of the business. Sports is a big thing for them, with ESPN driving a ton of their bottom line profit. The cost for sports rights continues to go up as more and more technology companies like Apple, Google, Amazon, maybe Netflix in the future get involved in that bidding process. So we see just the cost of content going up on sports, which is just starting to become more and more uneconomical for companies like Disney to keep the kind of leadership position that they had to the extent that they had it. So that concerns me on sports. Streaming, we just kind of went over how Netflix is dominating, and I like how streaming has the opportunity to give Disney global presence, but at the same time, it's still not profitable for them, and they're losing their linear profitability so quickly. It's disappearing so rapidly. I fear that there's a day in the coming couple years where linear pretty much goes away in terms of the bottom line help to the business. ESPN is in battles for sports rights with trillion-dollar companies, which is just going to get to the point of economic indifference for a company that isn't using it as a retention tool. The parks will kind of get tapped out on how much profitability that can be driven from that. And then streaming just will not be able to make sustainable high return on invested capital profits. And then they really just don't have anything going for them. And I'm really concerned that that may happen here, especially with how quickly streaming is going down, with how quickly sports rights are increasing, and these trillion-dollar companies are getting involved. So this is one of my most worrisome positions currently across all my portfolios. So going to be watching these earnings super in-depthly, going to listen to the call, going to see how the stock price reacts, and we'll see what I end up doing. But going over into the last story I wanted to talk about, it was the fact that not only did Netflix kill their subscriber number, they also made a huge deal with the WWE to move Monday Night Raw into exclusive streaming for 2025 for $500 million per year. TKO Group, which owns WWE and UFC, went up huge on this news, about 15% in one day. I think this is a really interesting move for Netflix, their first kind of dive into quote unquote live shows or live sports. And I think this will really help lower churn and increase retention on the platform, since it's a weekly show 2 times a week for Netflix. It is expensive for them for sure if you just think about what their overall budget is for content. They usually spend $20-25 billion. So this alone is 2-3% of their content spend on the year. But even when I say it like that, for the opportunity or the allure this has for lots of these consumers who are super big fans of WWE and will likely be watching on a weekly basis, the opportunity to bring more people into it by putting it on the platform, I think is a win-win for both WWE and Netflix. And it seems like Netflix got great long-term optionality to go from 5 years to 10 years to potentially 20 years. So if they just knock it out of the park, similar to how they've done with other sports shows that they don't own the rights to, the underlying sport, whether that's Drive to Survive with Formula One, or some of the other sports that they do, if they do their job and get much more people watching, much more interest, they can benefit for decades into the future with a much lower than market value cost on the rights. So I thought this was really interesting. I think it's a fair size bet for them in the grand scheme of things, given They're doing $30 to $40 billion in revenue, $500 million a year on estimated content spend, around 20 billion. Should be, enough to be relevant, but not enough that if it doesn't go very well, it's gonna, hurt them in any significant way. So I found that to be a really interesting deal. Looking at TKO Group stock here quickly, the stock in the past week here has gone through a lot. You can see the spike here, $77 to $95. So that there is closer to 20-25% jump. Quickly corrected down a bit to the high 80s, and then there was some drama on Vince McMahon, some allegations made towards him, and he actually just resigned from the board and the TKO Group after the bell on Friday. So we'll see if that has a positive or negative impact on the stock come Monday morning. But this one here has been a very volatile stock. I think they dipped pretty hard here after they signed an underwhelming SmackDown deal for Friday night. And then you see the Netflix effect here. So it will be interesting to see how this all nets out. The other interesting thing about the Netflix deal here is they plan on not having pay-per-view for their big events like WrestleMania, Royal Rumble, those kinds of things, which has the opportunity to bring way, way, way more fandom and eyeballs on the entertainment, which can have a huge ripple effect through the business, whether that's through merchandising, demand for live shows, et cetera, et cetera. So I truly think this is a huge win-win for both Netflix and TKO Group. Netflix kind of got those long-term options, and it's not overly clear what the contract looks like, but TKO Group really has an opportunity to future-proof their business from being cemented into streaming versus relying on cable. And in addition to that, can find way more incremental fans and attention through Netflix trying to get the content out to as many people as possible versus relying on pay-per-view revenue and promotions and stuff like that. So really looking forward to seeing how this works out, how TKO Group stock responds and what they say on their earnings call as well about this. But those are just some of the things that I was really focused on throughout the week. Next week, we have another week of a ton of earnings as well. So looking forward for those. Overall, the portfolios, as we started with, has been doing pretty decently. So hopefully that continues as well. And I can keep compounding with the dividends that I've been getting. Hope you guys like this video and this type of content. If you do, let me know in the comments, and be sure to give this video a big thumbs up. Like I said before, it really does help with the YouTube algorithm. I'll see you guys in the next one. Thanks for watching.